There are two main depreciation methods: straight line and diminishing value. Under straight line depreciation, the cost of the asset is depreciated uniformly over the life of the asset or the project. In other words, the same amount of depreciation is claimed as a tax deduction every year. Diminishing value is what's called an accelerated form of depreciation. The depreciation each year is a fixed percentage of the asset's book value at the beginning of that year. Sometimes instead of the term straight line depreciation, the term prime cost is used. There's a subtle difference between the two, but as far as this subject is concerned, we would treat them as being equivalent. Diminishing value is also sometimes called reducing balance, which means the same thing. Looking firstly at straight line depreciation, the annual amount of depreciation is generally the cost of the asset divided by its working life. The only exception to this is if tax law imposes some other constraint on the amount of depreciation that can be claimed per year. It is rational to claim as much depreciation per year as possible. So if the tax law allows you to claim more than the amount of depreciation indicated by this calculation, we would do so. This is in order to reflect the time value of money. The earlier we receive a cash flow, the more valuable it is to us. And as we said earlier, the depreciation tax shield, the reduction in tax payable as a result of depreciation, is an incremental cash inflow, and we want them as early as possible. We'll turn now to the second depreciation method, diminishing value. Under this method, the depreciation each year is a fixed percentage of the asset's book value at the beginning of that year. To calculate the amount of depreciation in any year, we multiply the depreciation rate by the book value of the asset at the beginning of that year. The depreciation rate is usually equal to 2 divided by the life of the asset in years. For example, for a 10-year project, the depreciation rate would be 2 divided by 10, or 20%. The difference between the two depreciation methods is that diminishing value results in more depreciation earlier in the life of the asset, and therefore less depreciation later in its life. Because of the time value of money, this makes diminishing value a preferable method to use. So if a company has a free choice between depreciation methods, it would be rational to use the diminishing value method.